If you run a theatrical production company in the UK, theatre tax relief can make a real difference to your bottom line. But the claims process has a few specific steps that are easy to get wrong if you haven't done it before. The first step is confirming eligibility. Your company needs to be a theatrical production company, meaning it's directly responsible for producing and running the show, not just involved at arm's length. The production itself needs to be performed live to paying members of the public or staged for educational purposes. On top of that, at least 10% of your core expenditure has to be UK expenditure. Once you've confirmed you qualify, the next step is working out your qualifying expenditure. Core expenditure covers everything from design to opening night, plus any exceptional running costs. But it doesn't include marketing, general running costs, or development costs incurred before the production was actually greenlit. When you come to calculate the relief, you take the lower of two figures, 80% of your total core expenditure, or your actual UK core expenditure. Whichever of those is smaller is the figure that the relief is based on. From there, you calculate your additional deduction and your tax credit. If you're profit making, you use the additional deduction to decrease your taxable profits and therefore your corporation tax bill. If you're loss making, you can surrender your losses at the relevant rate for a cash credit. Since April 2025, the rates have been made permanent. 45% for touring productions and 40% for non-touring productions. For example, a loss-making, non-touring production with £100,000 of qualifying expenditure, all in the UK, would have £80,000 of eligible expenditure and would generate a £32,000 cash credit under the 40% rate. Next comes the Additional Information Form, or AIF. This is mandatory for any claim and it has to be submitted before or alongside your company tax return, not after. Missing this step is one of the most common reasons claims get delayed. Finally, you file your company tax return. This means submitting the CT600 alongside the CT600P supplementary page, which is specifically for creative industries claims. One thing to keep in mind throughout all of this is your claim deadline. If your accounting period has 18 months or less, you have 2 years from the end of that period to submit. For longer accounting periods, the limit extends to 42 months from the start of the period. Getting accurate expenditure calculations, a properly completed AIF, and the correct supplementary pages makes the difference between a smooth claim and one that gets bogged down in queries from HMRC.